Welcome back to the channel, everyone. And for those of you who use dividend growth as a primary or even complementary strategy to build wealth or even just provide some passive income, this episode is for you. In this episode, we'll get into the best dividend growth ETFs for 2026 so that you can see if any of them are fits for your portfolio. So hit that subscribe button and join me today, right here in the red zone. Dividend growth is different than just dividend investing in that it seeks companies that are growing their payout, hence the second part of the term growth. It's also different from income investing. An income investing strategy is generally seeking an immediate high payout now versus the future and gets its total return nearly entirely from the distributions an income fund pays. Dividend growth can be an applicable strategy regardless of your investing time horizon, but as a primary strategy, you really either need to start early to allow several decades of dividend growth, or you likely need a large pile of starting capital so the initial payout is enough to live off of. It can be an appropriate complementary strategy regardless of your time horizon. Now, in order to do this exercise, we'll have to make some forward projections. And although we know that past performance is no guarantee of future outcomes, we're going to be using these funds' historical price movements and dividend growth in order to project future values as well as those future dividend payouts. We're going to use the last 3 years and project those out so we can put a ticker symbol like CGDV into the mix. So for the funds today, we'll look at CGDV, DGRO, FDVV, NOBL, SCHD, and VIG. Let's get to know each one of them a little bit. Starting off with CGDV, it holds 56 stocks from the S&P 500, including growth stocks like Nvidia, with its top 3 sector weights of technology, industrials, and healthcare. There's not much available about its stock selection criteria in the prospectus outside of 80% of investments are in dividend paying stocks. 10% could be invested outside the US and seeks to invest in attractively valued companies with long-term growth prospects. CGDV has beaten the S&P 500 for the last 3 years from both a total return and price return standpoint and is also our lowest yielder of the group at 1.28%. Although it grew its dividend from 2023 to 2024, its dividend growth stayed flat from 2024 to 2025. Next up is DGRO, which holds a much wider 406 stock portfolio with its largest holdings coming from the S&P 500 in the sectors of financials, healthcare, and technology for its top 3 in that order. DGRO looks for companies that have a history of sustained dividend growth. DGRO trailed the S&P 500 slightly from a total return standpoint and currently yields just over 2%. It has consistently grown its dividend over the past 10 years, and in the last 3 years has a dividend compound annual growth rate of just under 7.5%. FDVV is Fidelity's high dividend ETF that holds 123 stocks primarily from the S&P 500 with its top 3 sectors of technology, financials, and consumer defensive, with real estate as the 4th largest sector in terms of portfolio allocation. Its total return is slightly below that of the S&P 500 over the last year and yields just over 2.8%. It has a 3-year dividend CAGR of 8.44%, but it didn't grow it every year over that time period, as you can see. Noble invests in the S&P 500 Dividend Aristocrats exclusively, which are the 71 companies that have not only paid but have grown their dividend every year over at least the past 25 years. Those companies are primarily from the consumer defensive, industrials, and financial sectors. From both a price and total return standpoint over the last year, it performed poorly against the S&P 500 because unlike the funds we've reviewed to this point, only has about a 4% allocation to technology. The fund currently yields just over 2.1%, and although it invests in these aristocrats that have grown their dividends for 25 plus years, the fund itself hasn't actually grown its dividend every year since its inception, as occasionally a few companies will fall off the list by failing to grow their dividend payout. But over the last 3 years, it's grown its dividend every year with an 8.46% dividend CAGR. Next up is SCHD, which seeks to track the Dow Dividend Index and holds just over 100 companies with its top three sectors of energy, consumer defensive, and healthcare. Like NOBL, SCHD has underperformed significantly when compared to the S&P 500 over the last year, and also like NOBL, holds only a small allocation to technology. SCHD is the highest yielder at this point and currently yields 3.75%. SCHD has grown its dividend every year since its inception in 2011 and has a 3 year dividend CAGR just north of 7%. The last fund on our list from Vanguard is VIG, which holds 343 companies coming from the top three sectors of technology, financials, and healthcare. It has slightly underperformed the S&P 500 over the last year and currently yields about 1.6%. It has grown its dividend every year over the past 10 years with a 3 year CAGR of just over 6%. So, which one's the best? The best is really determined by your time horizon, your investing strategy, and your plan to turn your assets one day into retirement income. Since I don't know any of these for you, here are where these funds may fit into various investor types and strategies. I don't think I would recommend CGDV to anyone from a dividend growth perspective, as its dividend stayed flat from 2024 to 2025. It's a good fund that beat the S&P 500, but this is more of a growth strategy fund where you would use it to simply accumulate and then either transition these assets later to something that pays more, or alternatively sell down your investments to generate income. Despite dividend being in its name, CGDV simply doesn't really belong in this category, in my opinion. Conversely, DGRO looks like the best fund to me at present if you have a long time horizon, as it's currently only yielding just over 2%, but has grown its dividend every year over the past 10 and is growing it over the last three better than 7% per year. It also only slightly trails the S&P 500, so you're generally keeping up if that's a relevant benchmark for you. Now, that's a definite plus with investors with long time horizons because you may think that you want to live off dividends, but later want to change your strategy to one of selling your shares to generate income, and this fund would give you that flexibility without significant underperformance against an alternative strategy of an S&P 500 index fund. If you do have a long time horizon, but are adamant on not selling your assets, then Noble may be the best bet as its dividend growth is above 8% and is paying slightly higher than DGRO. Just don't expect to track the S&P 500. It is much more defensively structured, so we also would expect it not to lose as much in a down market as compared to the S&P 500, and we see that in Noble's beta of 0.78. FDVV is a solid fund, but because it didn't have consistent dividend growth every year over the last three, I'm taking it off the list for further comparison as the best ETF for 2026 because it's a good fund. I'll keep it on the long term watch list and revisit. SCHD is better for investors with a shorter time horizon as its starting yield is higher than the other funds and has still grown its dividend over 7% per year. Finally, VIG is a great fund, but I would eliminate it for investors with a long time horizon against DGRO as the best simply because its 3 year dividend growth rate is lower than that of DGRO's. By the way, When we say short term versus long term, what do I mean by that? So, if our assumptions were good, that the last 3 years are predictive of the next 30 years, which they won't be, but all of these funds are very good or close to one another, and there's no real way of knowing which fund will be the best over a 30-year period. But using those assumptions, we can compare a initial $10,000 investment in SCHD, which seems to be better for short-term investors, versus a $10,000 investment in DGRO and just see which is better and under which strategy. Here's a chart if we extrapolate the last 3 years of price appreciation, current yield, and 3-year dividend CAGR, assuming all dividends are reinvested in the time period. A dividend growth strategy for accumulation with a decumulation or selling your stocks for income, if those are your strategies, DGRO wins at any time horizon. Now, for a dividend growth strategy, again for accumulation, but with a pure income strategy during retirement, so no selling of assets, we want to live off dividends, we then see a break even point using those assumptions that we made of 22 years. So, if your time horizon when you expect to start wanting to use your dividends as income as opposed to reinvest them is less than 22 years, then SCHD is likely a good fund for you. And if your time horizon is greater than 22 years, then a fund like DGRO is better. I would also say, again, like I mentioned earlier, for longer term investors that are decades away from retirement, DGRO might be a better option as you probably don't know exactly how you want to generate income in retirement, nor might you care at this point. A lot can simply change over that time period. I don't know the answers to any of these questions, and neither do the experts, which is why I focus this video more on your longer term strategy and your time horizon, not just what might or might not happen in 2026. For my personal situation, SCHD makes the most sense for me as my time horizon is about a decade, and I first start to plan to generate retirement income first from the assets in my income portfolio, then later transition to adding dividends coming out of the dividend growth portion of my portfolio, and then finally, towards the end, decumulate the growth portion of my portfolio. So, which fund makes sense for you? Feel free to leave a comment below to let the community know which dividend growth ETFs you hold, or if there's a particular fund that I didn't cover today that you'd like me to do an episode on in the future. Although you may have watched this video because you want to generate passive income in the form of dividends, there are obviously other ways to do that than looking at dividend growth ETFs. If you're interested in other types of funds, check out one of my earlier videos from the channel on the utility sector. Until then, I'll see you next time, right here in the red zone.